Friends, now let's spend some time understanding these events after the reporting date. Importantly, we want to understand whether the events are adjusting events or non-adjusting events. And frankly speaking, as the name goes, accordingly the treatment is done likewise. When we say adjusting events, we are simply saying that the event has happened after the reporting date, but the financial statements for that reporting period shall be adjusted to accommodate such events because they are adjusting events, right? However, in case of non-adjusting events, we do not change those financial statements for that reporting period. We do not adjust those financial statements for that reporting period. Okay. Now, why we don't do it, and what are such instances? Let's try to talk about that as well. Okay. Say for example, I have a warehouse which I purchased long time back, and let's say the investment made is $10 million. Okay, and on the reporting date, the carrying value or the carrying amount stands at $8 million after depreciation, right? And on this date, there were some leakages identified, or even prior to this date, there was some assessment done by the company that there are some seepage, there are some leakages, there is something on the repairs part, or some maintenance is being undertaken on this particular warehouse where we are trying to kind of understand, we are trying to kind of look into it if something is really if everything is really good or not, right? So while these things are going on, you still charge a normal depreciation, and you said that this is what you got. The carrying value of the warehouse is $8 million, and after the reporting date, a few days later, but before, of course, the finalization of the statements, you observe that the leakage at that particular warehouse has actually resulted in a significant decline in the value of that warehouse. The recoverable amount of that warehouse could only be identified at, let's say, $5 million. Okay, so when I say I'm looking at this with respect to that inspection, that kind of maintenance, that kind of repairing going on, we say that the circumstances existed on the reporting date that something is going to happen. All right. For example, this decline in the value of that particular place, the warehouse, something is going to happen, and the situation was always there on the reporting data as well. It's just that it has not got really very clear in front of us. Okay, so when I say I'm looking at this kind of a scenario, it would be prudent for me to bring the value of this arrangement or this warehouse at $5 million instead of $8 million, which means that I shall adjust the value of my warehouse on the reporting date. How do I adjust it? I would simply say there is an impairment loss, and there is of course a reduction in the warehouse facility to the extent of course $3 million. All right, so that is a typical example of, for example, an adjusting event, right? On the other hand, if I say that there is something called as a non-adjusting event, I'm still carrying it at the same value, which is $8 million, but a few days later, a fire breaks, and and really damages that go down or the warehouse, and the only recoverable amount is now $5 million. When has this instance happened? After the reporting date. In fact, even this, in the first case also, the recoverable amount was identified at $5 million after the reporting date. That's the reason why it's an event after the reporting date. However, in the first scenario, the circumstances existed that there is something inappropriate at that warehouse, and accordingly you really go back. So this is during that reporting period. You're not making this adjustment after the balance sheet date or the reporting date. You're making this adjustment during that reporting period by bringing the value of that warehouse down by $3 million. But in this case, this adjustment, which is the loss, is only put in the financial statements after the reporting date, for example. All right. So importantly, what you need to assess is, do the circumstances exist, right? If they exist on the reporting date, then very well we can say that yes, it's an example of an adjusting event. However, if the circumstances do not exist, then it is not an example of adjusting event. And for non-adjusting events, we certainly give disclosures, right? If these events are material, then we are supposed to give appropriate disclosures, the quantitative disclosure as well, in terms of what is the impact of those events after the reporting date, although they're happening, of course, after the reporting date itself. What is the financial impact of those is also disclosed as a part of your notes there. Okay, so what could be, for example, the scenarios where we can say that something is an adjusting event or something is not an adjusting event, right? We can bring in perspective here that there could be a court case, okay, which has been pending for long, but now it has been finalized, which simply means that whatever is the court's decision, and if the company has agreed on that, because there is no other workaround or a way out left, and you believe that now you would have to probably pay some penalty, or it can also be argued that you probably would have won something, and it is fairly certain what are you going to pay or what are you going to receive back. So those court cases which have been settled or finalized, you really go back on the previous reporting date and make that adjustment in the financial statements. Okay, there could be an instance of where you have the information being available later on, let's say the asset being impaired. So there could be, for example, a customer's balance, there could be a receivable, right, who was not paying you, even the fact remains that the money was due, but now you believe that now you know that the client that customer has gone bankrupt. So the indications probably would have existed before, and now practically that client has gone bankrupt. So you would say you really go back on the reporting date and write off this entire debt. Okay, that could be an instance there. There could be, of course, a reduction in the value of inventory, right? And that has to be again brought back into the adjusting event scenario. You really kind of free seat from that perspective. And more importantly, inventories is driven by the inventories accounting standard as well, where we say that show the inventory at the lower of the cost or net realizable value. So that is something that you want to, look into it when you are looking at this kind of an adjusting event. Okay, there could also be, for example, instances where you are looking at say discovery of a fraud, which only comes in later, but of course the indications were always there that it existed. You just discovered it later does not mean that you would simply adjust it at that point in time. You really go back and adjust it. Okay, and then we start looking at how do we account for the fraud. We really go retrospective per se, right? So that's something which is again driven by the accounting standard on accounting policies, changes in accounting estimates and errors. So that is how you start looking at instances, some instances of what could be the adjusting events here. Okay, and then if I say I'm looking at non-adjusting events, there could be an example of let's say disposal of assets or even operations which has started after the reporting date. And why just disposals? It could also be about acquisition of a business, right, after the reporting date. It could be a major fire or an earthquake, for example, which of course was not expected, was not, the circumstances did not exist on the reporting date that yes, a major fire could break or an earthquake can take place, for that matter, as a part of the business there. Okay, there could be also, if not disposal, if not acquisition, there could be, for example, an announcement of a major restructuring, but then purely happening after the reporting date. That could be a big example of a non-existing event. I mean, something that did not exist on the reporting date is very critical to understand and getting into that. Okay, it could be even with respect to, for example, issuing some guarantees, after the reporting date. It could be purely a litigation starting after the reporting date. Now, importantly, when you look at non-adjusting events, the focus is disclosures primarily, and when I say disclosures, you are expected to provide all relevant details. Of course, we said before that, including the quantitative disclosure, and to be very importantly focused is looking at whether the going concern assumption is valid or not. That is to be observed. If I say, for example, there is a major fire which really takes away your entire business, which has practically destroyed everything of your business, you cannot really just disclose it, because the fact remains it's not a going concern assumption validity now anymore. So you need to be a bit more clearer in terms of what exactly to be done. If you simply would prepare your financial statements on a very different basis, because the very fundamental assumption is not there in your business now. So one needs to be understanding these aspects well and accordingly taking in view whether something is an adjusting event or not, because if you call it an adjusting event, you are really making those adjustments, the financial adjustments back in your balance sheet or P&L account in the last year itself. And if it's not an adjusting event, you're certainly giving disclosures. It all depends on whether the circumstances existed on the reporting date or not, right? That's it from my side in this case. Thank you very much. Good day. Take care. Bye-bye.